Good afternoon, everyone. Evening for some, morning for others all over the world. Welcome to today's live trade session. I see that you have met Antonio. Antonio, Antonio requested that we do a bit of a photo shoot. This is several years back. I don't know if you can appreciate how difficult it is to get a shot like that of a wasp. So I hope you can appreciate that because I was definitely putting my life in danger for this particular one. But it all worked out great. He just sat there while I took some photos and off we went. All right. So there's that. Welcome to today's call. We're going to get started here real quick. Quick announcement if you're new on the call. If you're not new on the call, you've heard me make this announcement many times, but we have a cool situation going on where you're going to be able to buy stock in Trade Partner. And of course, Trade Partner is the preferred trading platform on the trading on the planet, right? So um, we have a few more steps that we have to go through. It's a special thing where the SEC allows small companies like ourselves to sell a certain amount of stock privately to anyone. And so if you want to buy $100 worth of Trade Partner stock, you can buy $100. If you want to buy $100,000 worth of Trade Partner stock, you can do that. I'm not saying that this is at all where we're going, but it is, the direction. There are all sorts of directions that we can go and take Trade Partner. And if we were to choose the brokerage route, and I'm not saying we are, but I'm not going to rule it out either. Uh, Recently, Tasty Trade. If you're familiar with Tasty Trade, they went the brokerage route, and they just sold for $1 billion. One with a B, billion. So again, not saying that's what we're going to do at all, but you never know, right? So, hey, take a stab at it. Anyway, for those that are new on the call, I do want to welcome you, but I also want to warn you that I do not explain everything about the trades that you're going to see in today's call on the call, nor can I. There's just too much information. There are too many trades. These calls are meant to be cumulative. They are meant so that you attend a series of sessions and build on your understanding. And generally, what I say is it's going to take new traders who've never been introduced to my stuff in the past, probably 2 to 3 months before they should take their first trade. That's that's my suggestion. Not because what we're doing is difficult. It's because it's different. It's just different from what everybody else out there teaches. So don't expect to walk away from this call not confused because you will be if this is your first call. So it's not meant for you to understand everything. It's meant for you to begin to see, okay, I need to learn what these guys are doing. I also want to warn you that if you do understand what we're doing fairly quickly and you start to want to put together some trades, you need to start small because this is new and because even the most experienced option traders come in here and have not traded things like this or based on the concepts that we trade on. There are mistakes that can be made. There are things that you have not thought of or maybe not have thought of or don't understand. And so you need to start small and you need to make sure you're not reckless with how you do it. And you need to make sure that you follow the instructions. And that includes the context with which we make all the trades because it's the compounding. Compounding is where it's at. We're not trying to make a killing on these trades. We're trying to make $20, $30, $50 a week on average. And if we can do that and compound it, we're talking about significant growth over a short period of time. If you can get to where you're averaging $100 a week on these on some of these trades, on the trades that you can compound more efficiently, you're talking about growing your account by as much as $30,000 in 6 months. Now, you're not going to start off averaging $100 a week on these. It usually takes several months to get into the rhythm, get into a flow, make sure you understand what you're doing while you're doing it, and consistency and all that, right? So you don't need to though. You start, your first goal should be 20 bucks. First trade, I want to make 20 bucks. That's it. And once you start conquering that one, then you can start to increase your profit trades, the profit per size. And that is ultimately on a 5-year basis. If you can average $100 a week with these trades, you're talking about compounding this into over $3 million. Okay, so, and I'm not saying that you're going to do that, or some of you may get comfortable with, you grow it to 100 lots and then you just stop and everything just stays at 100 lots. You're still looking at massive, massive growth at that point. All right, so compounding where it's at, that's the context. That's what should drive your motivation to learn how to do this. All right, so we left on Monday, which I apologize again. I ended the call about 15 minutes earlier. Come to find out, I think so. I was actually sitting in a different chair that I normally sit in, and from the web, yes, I self-diagnose, but from what I could tell is that it was some sort of pressure on my nerve. Either I sat wrong or whatever, but I I can't explain I can't explain it, but I was sitting here during the call and I literally had this massive pain and I broke out into a cold sweat and it was like I was going to pass out right here on the call. And I get up and I walk. My office is actually in a barn. I have a built out barn on my property with this pandemic. That's where I office at. And so I walked over to the house, and by the time I got to the house, it was all over. It was done. So I don't know. Anyway, I appreciate that. We kind of left off early. So I'm going to talk about obviously the option insanity is what we're going to talk about first. Option insanity is where we are taking advantage of a faster time decay on an option spread with regard to selling Monday and buying Friday, and that's pretty much reverse of what some other things that we do are. And if you have the right combination, it can produce some dramatic probability and profitable trades on here. The problem is that depending on how you structure it, it's going to take, one of these trades might take anywhere from $3,000 to $10,000 in margin. And then also depending on how you structure it, you may have more risk in one type of trade or another. And of course, in the last couple of calls, we started focusing on, okay, how can we take these trades with lower risk? And why do I take something like this? This is a 5-to-1 ratio, right? And so technically, I'm naked 4 calls on this thing. But the reason that I'm willing to do that is because if we're trading here at 376, man, I've got a long way for that market to move up before it gets to my risk level. And while it's going up, I'm going through this profit zone. So as long as it doesn't happen too quickly, I actually have many opportunities to take a profit. And as a matter of fact, within a few days, I could have taken the minimum gain, $300. 285 was the credit. So within a few days of placing on this trade, I could have taken the minimum gain if the market would have crashed and been out, and that's that. But I didn't, and the reason I didn't is because the market was way down here, and we only had a couple of weeks to go, and I felt like if the market moved back up into the profit zone, then I would have more. I actually had a much higher probability of pulling out a much bigger profit on this thing. And if the market didn't do that, I was still going to make $285. So it really didn't matter, right? Because that was the 285 credit. So I held on to that. Well, lo and behold, all of a sudden, Monday, Tuesday, Wednesday, and now Thursday, this is the 4th day in a row the market has moved up. All of a sudden, we're trading above 385, or at least we were right before the call. And this thing doesn't expire for another week. and we're only 7 points away from my short. All right, but we are almost 10 points away from my break-even level. All right, so what do you do? What do you do? What do you do? Do you get out? Do you take, because I could have gotten out at a $400 profit, I think it was yesterday, right? And I did not. I did not get out of the $400 profit yesterday because, again, based on where we're at, I felt like this was a no-brainer. If the market were to continue to move higher, because I do have some positions that are risking a little bit next week around the 392, 393 area, and if that's where we're at, this will make a nice profit gain. But I've got this risk. What if the market skyrockets? All right, so here's the deal. If I get into this and the market, well, if I get into this and then we see what happened, market move down, then market just blasts right back up into this profit zone. And then we're getting to the point where, okay, you know what, this was a pretty big move to the upside. And do I really want to risk the outside, even though it's an outside chance of the market continuing to move up and actually turn this thing into a loser? And the question is, no, I don't. And if this was your first trade, absolutely not. If this was your second or third trade, probably not. Right? You want to go ahead and take the money, grab the profit, be happy, and reestablish the position for even further out of the money, which you can do, right? And we'll look at those again, right? But I didn't do that, and the reason I didn't do that is because I had a profit stacking opportunity. All right, now we've talked about profit stacking with risk-free calendar spreads. We've talked about profit stacking with some other stuff in the past. I know I need to get back to the profit stacking at some point, but it's a concept that you can apply to any type of option spread trading. And so this is one where I was able to do it. And how was I able to do it? Well, I was able to do it by offsetting the risk on this trade. And so what I did yesterday is I bought 4 February 12th 395 calls for 17 cents a piece. That completely does away with the big risk. I shouldn't say it completely does away with the risk, because there is some risk there, right at the 395 level, but it's very small. And I will most likely have many opportunities to exit. It does take away, it brings it down to a 217 credit, okay, from 285 to 217. But I still have this big profit zone, so I'm going to go for $500, $600, $700 on this trade is what I'm going to shoot for. And if I can get it, great. If I can't, it's there, and I'm definitely not worried about it, because if we go to 395, then I'm going to lose $100, $125 maybe ish. Probably not, because if I go to 395. Then my 395 calls are actually going to be worth something. They're not going to be worthless, and I'll have 4 of them. So if they're worth 50 cents early on Friday, guess what? I'm going to be able to exit those and probably come out very close to break even. But the real reason that I did this is so that I could put on another trade and not worry about the risk of this one. And so I could actually profit stack and do more option insanity to replace this one, while I hold on to this one for a bigger profit. Okay, so that's the idea. And so I added another one. This one's a little bit different. And I kind of went over this the other day. This is again a 5-to-1, but I only did an 8-point spread difference, and I did that so I could get the bigger credit. I wanted a bigger credit, and the profit peak is at like 395, right? Which is where my loss, which is where the loss peak on this one now is, right? So I completely took the major risk to the upside away. And at this level, if we go up to 395, then I'm going to be at the profit peak. But the problem is, at 395, it depends on how fast it gets there, because this is the 226.31. right? So we're trading down here at 385. We've got a long way to go before it gets to break even. 400, 401, somewhere around there. We're not going to do that we're not going to do that by Monday. All right. And I know I've said stuff like that before, and at least once the market actually did what I said it wasn't going to do. But 99% of the time, you guys know I'm right about this, right? So if the market does move way up here, now obviously I'll have to address it at that point. Um, but if the market moves way up there, we're going to be even more ripe for a retracement. We're going to be or a pause or something. I mean, this is a massive move that we back to the upside after it sold off a bit. It's 4 days: Monday, Tuesday, Wednesday, and Thursday. Which, by the way, when that happens, the probability of Friday being down is about 85%. So it's pretty significant probability of a pause. That's not what I play though. I don't play those. I just acknowledge them. Um, and again, any trade that you place on, you have to be willing to accept the risk of the trade in order to make proper decisions. Not emotional decisions, not panicking decisions, not fearful decisions, but logical decisions based on the probabilities. And so with this one, obviously there's no reason for me to worry about this one at this point. If the market were to go, how far does the market have to go up for me to realize the maximum risk on this? Like 415-ish. I think it's at 415, right? So um, that has to happen in the next 2 weeks, and it has to happen so fast that we go right past the profit zone, et cetera, et cetera. You get the idea, right? All right, so that's what I did. So I kind of prophesied. I already had one for this week, and I added another one because I got rid of this one. I got rid of the major risk of this one. All right, so that's for those who are willing to take the 5-to-1. That's kind of what's available. Something always to look for. Can I hedge it? And if can I hedge it? And I'm very, very cheap about this stuff, by the way. If I want to hedge this, I don't want to pay a lot for these calls. And so if I have to pay a lot, then I'm just going to go ahead and take my profit. That's what I would do. And then obviously reestablish the position and give myself another credit and push that profit bubble even further up. All right, so being able to hedge fairly cheaply was the catalyst behind me being able to profit stack that particular trade. So we'll see how that turns out. The other side of the equation was to just from the beginning create a very, very low risk, almost no risk, not quite no risk, but very low risk option insanity trade. This particular one takes about $3,000 to $3,500 to place on, and as you can see here, the risk is very small. This it could go to $50 at 380, could go to $50 at 390. Highly unlikely. What has to happen is that something has to be infused into the situation to drive the volatility up more than it is right now. And of course, we know as the market moves up, volatility comes out. And we also know that if we're short Monday, which we're short Monday and we're long Friday, so we have to be out of this trade by close of Friday, right? So if we're short Monday and there are no economic news reports coming out, and we're basically banking at all-time highs, or kind of sitting at all-time highs, which we are again. This is absolutely ripe for a volatility drop in the Monday option during the day on Thursday, during the day on Friday, and creating this profit bubble, right? So this is the following week. And what you'll see is that this particular trade is actually trading I want to say at about a 30-cent debit right now. And so we're actually making $30 on the trade, but we're a week out, right? So we're sitting right at the profit peak, but this particular trade right here is next week, not this week. So we're not going to have near the profit in that trade. All right. If this is where we're at next week, then this is what we can expect, or fairly close to it. Okay. Now, having said that, you can also do these very, very low risk, very high probability scenarios. We talk about the relationship between the strikes and what that does to the risk graph and how that works on the risk graph. And this, of course, is where we have two short options that basically split the long strikes, right? So the long is 380 and 390, and then we have 385s that split that. Two 385s that split that. What happens if we were to split the 385s into two and go one 384 and one 385? What happens? Well, that creates a bigger credit, right? So we create a credit here because we're trading a 380, we're selling a 384 instead of a 385, so that's going to be worth more, right? So we create a credit, and then we also create a 1 point extra difference between the the short strike and the long strike. And so that credit increases the profit to the downside, but on the flip side of that, we create risk to the upside. That's how it works. The more you work these out in the risk graphs and stair step these strikes, the more you're going to understand the relationship between the strikes and the credit and whatnot. So along those lines, here's a similar situation, one that I was filled on this morning. It's also filled on several of what I'm about to show you yesterday. There are some really good trades that you can take on Wednesday afternoon, Thursday morning. That puts you in a pretty decent scenario. And so this is one that I was filled on, and you can see here the two longs, so 380, 386, and then I've got a 383, 382. So I could have gotten two 383s, right? Two 383s, and that would have split my 380 and 386. And then that would have been equal if it would have been at a credit of 20, then I would have had $20 profit to the downside, $20 profit to the upside, a big bubble in the middle. And then at the long strikes, you'd have this little bit of a dip below the zero line, right? That's how it works. But by creating one of the shorts a little bit lower, bringing in more premium, then I create a credit to the downside and a little bit of risk to the upside. And I did that because of the probabilities. I put a bunch of these on that were more bearish because of moving up again this morning and being the fourth day, and then the 85% probability of the market moving down after 4 up days. If it holds, actually the probability of a market coming off on Thursday afternoon is fairly good as well. So if we see that, then obviously we will have moved away from this risk zone. We're trading around 385, or we were right before the call started. So if we move down a little bit, I'm going to move right into the profit zone. 382, 383, I'm going to move right into the profit zone. And it's a quick 2-day trade type deal that you can just add a little bit of money to your account. Again, unfortunately, the drawback with these is that it takes about $3,500 in margin, because you do have to have the margin hedge. And my margin hedge on this was 400. I could have gone smaller or lower, but I literally paid 1 penny for my margin hedge because we're so close. That's one of the benefits of doing it this close is the margin hedge is a lot closer than it would normally be. So $3,500 account, you can place this trade or thereabouts. You can place this trade, and you make $100. Potentially make $100 on the trade. Okay. All right. So we'll get back to a couple of different option insanities here in a minute. Let's talk about the one that we've been watching now for the last couple of calls, where we went way out of the money. Then the market came way down, and now we're going right back up. Well, this one ends tomorrow, and the profit peak is at 390. And so guess what? There is no reason on this one to do anything other than either take the profit or hold. You can definitely hold, because if we do move up to 388, 389, 390-ish, somewhere around there, we're going to have a nice profit peak on this thing. So right now, this happens to be at a 65-cent debit. 65-cent debit, which means I'm making about a little over $100 on this trade. Okay. If this is your first trade, what do you do? Anybody. That's right. If this is your first trade, you get the heck out. Not because there's a whole bunch of risk to the upside, but because you need to get into the habit of being willing to accept the profit that it has been given. If the market comes back down tomorrow, so we're trading at 385, we're at about $100 profit. The market comes back down tomorrow, you're probably gonna see your $100 profit drop to maybe $50, $60 type deal. If we go down to 383, 382, somewhere around there, $50, $60. Of course, the minimum gain on this is $37. If the market moves up tomorrow, then you might actually see the profit potential go up to like 200-ish, somewhere around there. It's probably not going to go to 390. Not out of the question, but probably not going to happen. So a couple of things: you can either decide to get out now, decide to get out before the close. You can decide to get out tomorrow on the open, near the open, wherever it may be, et cetera, et cetera. Or one of the traders last week mentioned about something that he did, and that's certainly available here. Is you can get out of the 388, 392 call spread, and you can hold on to your calendars if you want. Okay, because you could basically take the call spread for the entire credit of that spread, right? So there's almost no risk, or you've got all the profit potential out of the 388, 392, and of course that's what we use to pay for it, right? We use that to pay for it. So we'll look at that and the open position here. And then here's another one where it was more risk. And this is actually one that's next week, or I should say a bigger credit. And this is one that's next week, and it's a 388, 394. And I say more risk because I went ahead and decided to make this 394 instead of a 392. And so I paid less, but I got an 84-cent credit on this. What about this one? Well, actually, I don't know where that one is trading at, right? We'll take a look at that one as well. And then I'm in another one where we have 385 calendars, which we put on last week, and we put them on more calendars as opposed to credit because the market was already down, and I wanted to create the profit bubble in here. Well, those are losing a little bit of money right now, not a lot, but losing a little bit of money right now because we're still a week away. So it's a little bit early for us to be jumping into the profit zone, but that's where we are. We're in the middle of the profit zone, and we don't have the opportunity just yet to take a profit on that one. So let's pull in a couple of different ones that we are looking at. So let's take a look at this one. 2825, 28. So this is the one that we're in. Okay, this is let's see. This is the 388, 392. That's February 8th. So actually, this one is, yep, that's 2528. So this is the one that we're in right here. Okay, you can see here we're in from a credit of 37. It's trading at about a debit of 70. So technically about $105, $106, $107 profit on this trade, with the profit peak yet to come. So take a look at these. You'll see here that there's actually 15 cents. Right, so all but 15 cents on the credit spread, which is 388, 392. I would not be concerned about this at all. I mean, you could go ahead and get out, and if the market moves up, you could put it back on, and maybe for a little bit more. But literally, it's like tomorrow, right? That we have to be out of this thing. So, my inkling is, depending on what you've got to the downside, depending on how many trades you take, and depending on how many of these that you've watched, et cetera, you can either be aggressive, go ahead and get out, or you can hold on, and if the market moves up, you might add another $100, fairly quickly to this thing. To take a look at this, so I've got the spread pattern generator here with Trade Partner. If you're not familiar with Trade Partner, this is just one of the many features that we've got that make it, everything about Trade Partner is geared towards my way of trading. That's why I created it. So we've got a spread pattern generator here where we just take a look at the same spread up and down the range. So here's where the short strike is 380, 384. And then we have the 382. So this one's in the money. Okay. This one's in the money right now. And this actually probably will be close to a break even tomorrow. If we got in at a credit of 37 and we were to go, so we're 3 points past the calendars, 3 points past the calendars, and we're only taking, I know if we were in this, we'd be only taking a loss of about $70. And if it stays here tomorrow, this will probably come down just a little bit, because there is still some extrinsic value in the 382s. And I don't think there is in the 380s, but we'll see. This one, if I were in this trade, this is my first one, I would probably look, if I were in at 37 credit, I would probably take the loss and put on a bigger trade for the following week, and make sure that I can make up that loss for the following week. Right, further away out of the money, focusing on a bigger credit, and do it that way. Because the risk on this is absolutely limited. It's limited to $370 if the market absolutely skyrockets from here. It's not a wrong decision to hold on to it by any long shot of the imagination, because what's going to happen, or what could happen, especially now, and this is what I do, right? You'll see me do this again and again if we move into a situation where the market is trading above the risk level, past the profit zone. Is if the market moves back down tomorrow to around 383, 382, you're going to have a nice profit on this trade. It's not going to be huge because we're only in 3 calendars, but it would be a nice profit. So I'm just projecting here what would happen if the market moved up, because of the trade that we're in. For us to be at a 105 credit, like you're seeing down here, we'd have to be trading at 395. Okay, so, or excuse me, 393 by tomorrow. 393. All right, so we're trading at 385. I can't say it's absolutely not going to happen, but it's probably not going to happen. All right, that's not the probabilities. And so if I were in this trade, because I've been doing it for so long, I would absolutely hold on to this and see and try and get out at a profit tomorrow if the market comes back a bit. I wouldn't get greedy with it at all. I wouldn't get greedy with it, but I would absolutely try and get out at a profit, which has happened twice now over the last, I want to say over the last 3 months, we've seen twice where the market has jumped my profit zone and gone past my profit zone. And then by the time it expired on that Friday, it came back into the profit zone, because that's how the markets work. Makes a run, pauses, retraces, makes a run, pauses, retraces, etc., etc. Okay. All right. So just kind of going here and taking a look at this. Look at this. This is a 105 credit. If the market moves down 1 point, you're looking at a $60 credit. Now that's a loss that's $23 if you're in from a credit of 37. And again, what I'm doing is I'm comparing. Okay, what if this were, what if this trade right here were in the money? That's what I'm asking myself. What if this trade were in the money? So the market would be trading at 393-ish, right? And this shows a loss of about $100, whereas we're not at a loss of $100. But so if this is the trade I were in and the market's up here, what happens if the market moves down a point, down a half a point, down 2 points, et cetera, et cetera? All right. So that's what you get with comparing these spreads. Is you get the ability to take a look. Okay, if the market moves down 1 point, because that's the way these spreads are created. Is here's a 380, 384 with the 382s. Here's a 381, 385 with 383s. The next one will be 384s for the calendars. Next one will be 385s for the calendars. Next one will be 386s for the calendars. Right? You see all that? So you get to the point where, all right, if I'm past the calendars by 3 points, and I'm losing $70, and the market moves down, what should this be at? It should be at a credit of 60. I'm in from a credit of 37. So I'd have a loss of $23. If it moved down 2 points, look at this, I'd have a gain. All I need is for the market to, and it doesn't have to stay there. All it has to do is go down there and give me enough time to get out if it goes down there, right? And you can already have your target in. You have a 37-cent credit. You can get out when it hits a 10-cent credit if you want. That's $27. You can't complain. $20. Of course, you now in context, just to be make sure everybody understands this. This market, you could have taken a $37 profit, last week, right? And so I kind of do the same thing. Why take $37 profit when I know I've got that in the bag? And we're so far down that any market movement to the upside should put me in a profit zone where I will have a very high probability of taking a bigger profit, which of course it did do. So when I say $27, we already had an opportunity to take a $37 profit on this trade. So this is a situation where you never had the opportunity to take a profit on the trade. And so that's moving down just 2 points from where we're at right now. That's all. If it moves down 3 points, look at this. I'm going to be making $70. And that's if it happens now. If it happens tomorrow, that puts us, if it moves down 3 points, okay, if we were in this trade and the market moves down, not this trade, this trade. If we were in this trade and the market moves down 3 points because we're trading at 385, then it would move to the profit peak of 382. That's where the market would be if we move down 3 points, and so my profit would probably be bigger than $70 on this. This is just right now before the calendars are completely devalued, because you'll notice on 385 there's $1.39 of value there. 385, and this expires tomorrow. If the market expires at 385, this is going to be basically worthless. So there's a lot of room for increased profit here. Again, moving down, if the market moves down 4 points, we're basically where we are with the current trade, which is at a 68-cent debit. Moves down 5 points, or an 89-cent debit, and then it kind of basically peaks at an 89-cent debit, and then it starts coming back down again. 79, 64, 49, 38, et cetera, et cetera, et cetera, right? So any movement down, and we're going to be fine on a trade if this was one that we're in and it was at a loss and expired tomorrow. All right, so I wanted to go over that um, because we might be in that situation next week with some of these trades like this one. This particular trade right here is next week, and the calendars are at 390s. So who knows? We might get to 390 next week, 392, 393. It's not likely, but it's not so out of the realm of possibility that I wouldn't absolutely be watching this for a profit. And let's go ahead and take a gander at what these are for next week. So what I'm going to do is, rather than create a whole new pattern, I'm just going to change the expiration dates on this one because it's the same trade, right? We took the same trade on these. Only, actually, there was one thing different. Yep, there's one thing different, and that thing different was I'm long the 394, which is 6 points away from my short on my diagonal spread instead of 4 points away. So I got a little more risk there, but again, I did it at an 84-cent credit, not a 37-cent credit. So I started off with pretty decent sized credit. All right, but let's take a look at 212 and 216 and then 212 and then 216 and reset the spreads and generate. So next week's 388, 392, 390, 390. What if I were in this trade, which I basically am? What if I were in this trade from a credit of 37 cents and I have a full week left to go, and I'm trading now at a debit of 59 or 60 cents? My profit here is $97. Take it or no? Take it or no? Take it or no? You take it. Everybody, you take it. You have $100 profit with a week to go on the trade, and we're only 5 points away from the calendars. You take the profit. It's a no-brainer type deal. Now I'm actually in this one, 94, or actually it'd be in 92. I'm sorry, 94. All right, so I'm in the 94. And the 94, and I'm in that, by the way, I'm in the 94 from a credit of 84 cents. So this is at a debit of 20, which means I have a profit of $100, $104, $105, right? Now this one I have bigger risk. Take it or not? And the answer is absolutely yes. Take it. Take it. Everybody, this is a no-brainer. There's no reason to hold on to this. Take your $100, be gone. The risk, we're trading too close now, and there too much time for us to hold on to this. So let's take a look at what these are as we start moving, right? So we'll start with in the money. Here's a 380, 386. That's in the money. I'm in from 84 cents. Look at this. This is trading at a 201 credit. So I'm in from 84-cent credit, means I'm losing about $115 if this were the trade that I'm in with 382s. Okay, so it's not spectacular. It's not like this, oh wow, I'm losing a whole bunch of money. But what would the market had to have done to get to the point where I'd be 3 points past the calendars with a week left to go? Right, the market would just have to go to just this massive, ballistic, unbelievable movement to the upside. Right? I would rather. That's why I would rather, if I'm in this situation, take the gain. Give myself a bigger credit on another trade the following week or the week after that, and knowing that I'm probably going to be able to take a gain on that early, right? And so when we put these out, 2 weeks out, 3 weeks out, to get a good price and push the profit zone way up there, it's because we most likely will be able to take a profit on the trade early. If the market moves down, so let's say in this trade that I'm in, not this one, but in this one, if I'm in this trade and the market moves down like it did, like moved way down, I'm not worried about putting on another trade at that point, because and while I hold on to this one, and for that matter, if you really have to, for example, on this one, if you really have to, when the market moved down here, you could have bought a 392, a couple of 392s for really cheap, and done away with the risk and started to use that as a profit stack. Absolutely available to you at that point, right? So you can always think about, all right, market made a big move. I'm in a credit of 37. Might as well hold on to it. Well, if I can buy a hedge at that point because the market moved down so far, and these are basically worthless at this point. Might as well buy the hedge for, and I mean, don't pay much at all, like 2-3 cents type stuff, and then add to the trade. Maybe have the profit zone a little bit closer, 384, 385, 386, somewhere around there. If the market pops back up, guess what? You're going to be right in the profit zone of that one. You're going to be in the profit zone of the second one. You're not going to have any risk on that first one. And if the market continues moving up on the second one, where the profit zone is lower, like in this area, guess what? You've got this one working, right? So it's a profit stack. You can profit stack any of these as long as you understand what you're doing, why you're doing, why you want to profit stack. You don't want to profit stack and increase the risk. That's what you don't want to do necessarily. Okay, so all right. Now I know I took a lot of time explaining those, and but Thursday is generally when we talk about exits and whatnot, because it is an important piece of this puzzle, because we increase our probability of success by exiting in a smart manner dramatically. So let's take a look at what's available, because with the market trading where it is right now, yeah, I definitely want to put on some trades, and I'm going to be leaning towards a bigger credit on the trades because of how the market's moved up. Now, personally, I'm going to tell you this: I think eventually we're going to 400. I think they're gunning for it. I think they're going to push it there. I just don't know that it's going to be immediate. I'm thinking maybe by the first week of March. Maybe the first calendar, depending on where we're trading, how, what happens in between now and then. I'm thinking somewhere around the time of the first week of March, we may push our way to the 400 level. At which point, you'll see some pretty bearish trades being put on from my end at that point. So let's take a look at see what's available on 222 and 219, 222. And I want to do the 4-point difference, so we can do the ones that have lower risk. All right, and then we will reset the spreads and hit it. So this one right here, 388, 392, 380, and with the 390s, going 2 weeks out now. 2 weeks out, it's trading at a credit of 19 cents. If we're trading where we are right now, next week we'll have a profit of close to $100, $80 ish, right? Based on time decay of this one. However, this is a little close for my comfort. If I want to be doing something that close, I want to do a little bit more of a credit. But let's take a look at some of these that are actually where we're past past the calendars, right? Which you don't want to do because you don't want to put the trade on. Right? You don't want to put the trade on when we are trading above the or past the risk zone, right? Even though you have a much bigger credit, any movement down and all of a sudden you've got a nice, you got a nice profit. Your risk on this trade at $123. Let's see here, $123 credit. That means your risk is 270 technically. So it's a smaller risk. And the market does have to move up significantly for the max risk to occur, but it's not near as much. You definitely have to see the market move down a little bit in order for you to have a higher probability. You might take a small gain on this one if the market stays exactly the same, right? But you don't want to do this. So we always look, we go, how far can we push them out? And create a credit. And the furthest we can go is 389, 393 with 391 calendars. And that's at a 7-cent credit. That's, to me, this is probably, we're probably past that. So I'm actually going to, as far as using this as the criteria. Now, if I wanted to, I could do a credit spread instead of a diagonal spread, right? And then I'm going to bring in a more credit, but my risk doesn't change, but the probability of realizing that risk is a little bit higher by creating the credit spread instead of the diagonal credit. Okay, so with this one, the 388, 392, and the 390s, 51-cent credit. If I'm more bearish, I have no problem doing this. I do it all the time, as a matter of fact. If I'm more bearish, then I have no problem doing that. So let's see how far we can push that one out. And this is the 17, 12, 5. So you can go 393, 397, and do some 395s, and your profit peak is going to be there at the 395s. And you've got a credit, right? So you're not going to lose anything, but you're not going to make anything if the market drops down either. That's about as far as I would go with this particular week. Is the 393, 397 with the 395s. So that means, we're trading at 385, and if the market were to move up to 390, 391, 392, 393-ish by next week, guess what? This is probably going to have a profit. And so you'll have the ability to go ahead and get out early. So you're just not going to make anything if the market moves down. All right, so let's then go out the following week, which is 226 and 3-1, and just to compare some of this stuff. So this is the current one. Now this is 3 weeks out, and you have to be aware that the more time that is left on the trade, the more likely the market is going to make the move. The more time you give, the bigger the market can move, the higher the probability the market will move to the upside, right? So how far can you push this one out? Looks like about 393, 397, 395s. And you can do the 5-cent credit. So about the same as the 1 week prior, only with the credit spread instead of the diagonal spread. This one, you can do it with the diagonal spread. And that's just going to make it, again, a little bit, make the break-even level just a little bit further to the upside, make it a little bit more harder to actually suffer the maximum risk on the trade, which is $394 if you get filled at a 6-cent credit. And the probability of realizing that $394, that's going to be probably somewhere around the 405 to 4. Oh, you know what I did? Sorry, guys, I didn't reset the spreads. So I'm telling you, the 219. There we go. All right. Now we're going to see how far we can push this. So 391, 392. So it's still there. So 226.31 diagonal, same thing. 93, 97, 95s. Probability of realizing the maximum risk on that trade is going to be probably around 405-ish or above. And you're talking about, well, let's just see, a 405 on, and again, would be assuming that you hold on until expiration, which of course, most of the time we do not do. We do not want to be, if you're holding on to the absolute last minute, you're probably doing something wrong. Because there's just too much that can happen in the last minute. You know, a 200-point swing, if you're in the middle of the profit peak and you're trying to get the maximum profit, and it's 3 o'clock in the afternoon Eastern time, I've seen the market jump up 200 points in the last hour and put you and just basically give most of your profit away. 300 points, something like that. So let me see here on SPY. The 405 level that expires on February the 26th. You're looking at about a 6% probability. So you have a 94% probability. If you hold on to this trade until the end, you have a 94% probability of not realizing the maximum loss on this trade. So that kind of gives you, one of the reasons why I say you have to be willing to accept the maximum loss, the maximum risk, because the probability of realizing that maximum risk is so, well, part of the reason is because the probability of realizing that risk is so small. And the probability of you being able to get out earlier is very, very high. All right. So what I'm going to do is I'm going to flip this around, and I'm going to, let's see here. I'm going to do a trade. If I can find a window that I'm not using for that. All right, so here we go. I'm going to go place trade. And I'm going to do it one order. And I'm just going to let it sit. Whoops. And I'm going to go, let's see, we're going to do 219 and 222, and I'm going to do a credit spread. All right, so credit spread, not the diagonal, is what I'm going to do. So I'm going to do the I'm going to go with the 390s, and I'm going to go with 395. Okay, so I'm going to do a 5-strike difference. So 390, 395 credit spread, and then I'm going to do 393s on the calendars. Okay, and I'm going to do it at a credit. So I've got, so I'm going to do this one, and it's going to show at a 58-cent credit is 65.51. So it might be 55, 56 cents that I actually get filled. Oh, there's a 55. So I'm going to do credit, and I'm going to go 55, and I'm just going to sit it there at 55. I got to put it in the right account. And all right, so there we go with that one. And let's take a look. I'm going to throw it on a risk graph real quick for you guys, and then we'll be done. This isn't this fun to go through all of these. So I said 219, 222, right? All right, so I did a 390, 395, and I'll just do 391, and I'll change it here in a second. And then the 393, buy. All right, I'll fix all of that up there. I didn't want to go in there and increase the number of strikes that we see. All right, so this is a sell, not a buy. I was thinking option insanity. Let's see here. There's a sell, and this was a 395, so I'll redo that one. And then the 393s were the calendars. And I did 3 of those, right? And so 3 and 3. And I actually did those at a credit. So that's because this is 19. There we go. And credit 50, so 54. There we go. Oh, duh. That's not what that is. Those are calendar spreads. I can't talk and do 2 things at the same time. All right, so there it is. I'll redraw the perspective here. We'll go 395 and 380. All right, so it's not huge. It's not a huge profit. There's not a huge profit zone here. The only reason I'm doing this is to push that break even a bit and create the credit. I want a 50-cent credit, actually a 55-cent credit is what I've got the order in at. This is not one of the higher probability trades, but it's one where I'm going to make a little bit more money if the market moves down. And I want to have an opportunity if the market moves down to either hedge it or take a profit, fairly quickly and just hold it. And then it's only 2 weeks. So if the market does make a move up, let's say another 5 points by this time next week, another 6 points, 7 points, I'm going to be in the profit zone, and I will have a pretty decent shot of taking a profit since I got a 50-cent credit on this. All right, so, or a 55-cent credit is what the order is in at. All right. All right, so if you don't want to do one that is at such a big credit and you want to push that risk zone up there, you can definitely push that risk zone up there, and you can do one that is, you can do like maybe a 5 diagonals, right? And then you'll create a much bigger. It's going to be a little bit more than that. Those are not 5 diagonals, 5 calendars. That might be closer to an even Steven. Let's see here if we can find that. So you can push that up there, right? You can push that break even a little bit further out. You can push that profit zone. You just are not going to make as much money to the downside. So if I do, where is it? What is this one? This is not it. This is my weird. Oh, well, I completely lost the one that I was doing. Here we go. Let's go with 5 calendars. If you're a little concerned about that being a risk level, let's go 219, 219, 219, and 222, I should say. Right, so that's trading. So 388, 392, 390s. You can go 395. That's the 393. Okay, so that would be a 5-point spread. You'd have 5 calendars and still get an 8-cent credit. So that's going to push the profit peak at the 390 level way up there, which will give you a higher probability. So you can do that if you want, and you can check it out with how far you can go and create that credit to do that. But it's certainly possible. Okay. All right. Let's take a look at questions. And I know I didn't get to the other option of Sandy stuff, but we'll talk about that in the next call. What is the pattern for the 2, 1, 2, 4 points between 2 and 3 strikes? The risk-free calendar. Create the risk-free calendar. Let me see here. So let me see if I've got one open real quick. And I don't. So let me get to that. Let me get to that in Monday's call, and I'll revisit that one. Let's see here for a risk-free calendar trade, starting with the 112 pattern. If you are unable to get the buy option at the same price as the sell due to a price movement, it will point to you make an adjustment and how. I have a short 387. Let's see, 387 short, 392 long, 394 base trade. I would hold, Patrick, because you're still so far up there. You're going to see a lot of time value come out for these in the next day or so. Ryan, why do we need margin hedge 1-2-1s if it has 2 calls and 2 puts? Because the shorts, the longs are not on the same expiration. You have to have the longs on the same expiration or after your shorts. If your longs are before your shorts, they're still going to charge you full margin. Are you sharing the trade you are showing in this webinar? If so, where are they located? No, I do not send these out on Trade Partner. And the reason I do not send these out on Trade Partner is because when we started doing it, there's a lot of different ways of doing it. I show you what I'm doing with my experience level, my my proclivity to bigger credit when the market moves up. It's not necessarily what you should be doing, and I don't, I don't want to say one trade fits everyone the same because it does not. And so I show so many of these that, and I go through so much detail. I purposefully do not send these out on Trade Partner because of the diversification that is out there with regard to the number of traders and their situations and what they should be trading and what they maybe not should be trading. Let's see. I find it super useful when you ask, would you stay in or get out? A huge part of the magic here is when to get out. I need to fine tune that. It's not one, that's a good statement, but it's not that you need to fine tune it. It's just that you need to really grasp the logic. Because if you really think about this stuff, it's common sense. If you understand what happens if the market does this or if the market does that, where you're at, how much time is left, it takes a little bit of time to to process all of that to where it's second nature. But once you start doing it, it is common sense. And if ever in doubt, if you've got a profit and you're ever doubting, I can tell you right now, you should take it. Okay. Again, we're not in this to hold on until the last day, last minute by any long shot of the imagination. That's not why we're doing this. And in fact, doing so can actually drop the probabilities. Instead of doing 5 390 calls, could you do 3 390s and 2 395s? Yes, you absolutely can. If you want to, you'll obviously blunt. It's like hitting that profit peak with a hammer, and you'll flatten it out a bit, but it will spread that out a little bit further and push your break-even point just a little bit further as well. So you can do that. You also, just going to tell you, you probably will diminish the early exit by just a little bit, the probability of early exit, because the further away those calendars are, the lower they're going to come into play. The lower the probability that they're going to come into play and actually boost your profit, your open position profit. As far as being out of the money, in the money, it's a different story. All right. Looks like I got all the questions on there. All right. So what we did today is we just basically did a variation of, let me show you. We did a variation of this to where the calendars were at 393. So we put a profit peak way up here. We're trading around 385. We put the profit peak way up here. And it's only 2 weeks away. So we're not giving it a whole bunch of time to move way past our profit peak and not be able to get out or do anything about it. So we'll see where we're at on Monday, obviously. And also be watching these. Be watching the ones that are literally a 2-day trade, right? I'm losing a little bit of money on this one. Totally fine with that because we're still trading below this peak here, this loss peak, and any movement down, I'm going to be going into the profit zone. So obviously this is just one of those things. This one is next week, so we may still be in this one by Monday. All right, that will do it for today's call. Appreciate y'all attending, and I will see you on Monday.